So this is a short video about common size income statement. I'm on Yahoo Finance, and I chose Apple, my usual lecture company, because they have enough information, financial information available, and make it very nice and easy for lectures. So I went through the financial tab on Apple's page, and this is the income statement. And notice that currently annual is chosen. I will be using OpenOffice simply because it's free. You could use any spreadsheet that you like. Just as a indicator, I'm just going to type in the symbol for Apple. So the idea behind a common size financial statement or an income statement is to be able to compare two companies. So I can compare Apple to a competitor, or I can compare Apple to a company that it actually is working in a supply or on a customer basis. So let's calculate one for Apple, and then maybe for a couple of ratios, we'll calculate it for another company, and then we'll talk about how using a common size income statement actually makes it relatively easy to analyze financial statements. So we start with the most current year, and I'll go with the total revenue at the top. So total revenue, and our total revenue is, notice these are all in thousands. So this is $260 billion, 260 billion, $174 million. So for the ease of this lecture, I'm going to just go with the billions, right? So just going to say in billions. So this is September 30th, 2019. So their fiscal year ends in September, and the total revenue is 260 billion. Now then, each of these items, we basically take it and divide it by the total revenue to come up with the common size income statement. So the cost of revenue is about 162. So cost of revenue, and these are some of the items that they simply cannot really help change. So for instance, for an iPhone that they produce, they actually have somebody else produce it for them. Apple Designs does not produce. So they have suppliers who produce for them. So the cost of revenue usually means how much of that revenue they're paying it out to produce their goods. So it's 162. I'm just gonna right? So in this sense, the common size income statement then would be 162 divided by 260, and this is for 2019, and it was 62%. So 62% of their revenue is spent on cost of revenue. So just want to make it a little bit fast and easy. I'm not going to go through each and every item. Basically, the common size income statement, takes each item and divides it by the total revenue to give you a percentage of the revenue either earned or spent in the income statement for that specific item. So the gross profit then, right? So in this case is about 98 billion. So the gross profit is about 37%, 38% approximately of the total revenue. So any revenue that they generate, only 38% of it is actually left with the company after they pay for the cost of revenue. So if I were to look at, say, and like I said, we can go through each and every item, which for an assignment, you will. However, the idea now is to understand why we use this and what it really is. So I'm just going to go to net income, and so we go and then we have net income right here. So the net income is for the same time. So same tax year is 55 billion. And then we divide this by the total revenue. So we see that about 21% of total revenue is actually turned into a net income for Apple in 2019, which is actually substantial. So, Apple is one of those companies that has a very high margin. So this is what we refer to as the margin, gross margin. And the net income ratio, which is the net income divided by the total revenue, is the 21% is quite nice. So just to compare this now to another company, I'm just going to look at, or before we do that, let's go through the previous year just to see if we have a significant difference, right? So this is 9/30/2018, 1 year before. Total revenue was about 265.5. It's right there, so I'm not going to round it. But the cost of revenue is about 164. And then the gross profit is 101. So the gross profit really is just the total revenue minus the cost of, total revenue minus cost of revenue. So maybe I should do the same right here, total revenue minus cost of revenue. And then we divide each item by the total revenue to come up with the common size income statement. So those are your percentages. And then the net income for 2018 was about 59.5. I think that they actually done a little bit better in 2018. So let's take a look. Yep, slightly better, but better nonetheless. So their margin, so their cost of revenue has increased in 2019 slightly, but it is a large company, so even slightly is saying a lot. And their gross profit is shrinked just a little bit. And in the same, path, same pattern, the net income is slightly better in 2018. So this is the 2018. Now let's do the same. So I'm just going to copy this and go right here. But this time I'm going to compare, say, Walmart, a retail company that has nothing to do with, being a competitor to Apple or any of, no, it's just a random company that I just chose. I go to financials and income statement. So just want to make sure that I'm on the income statement and it is annual. So first of all, their financial or fiscal year is different. It ends at the end of January. So, a few months of a difference, but difference nonetheless. So 1/31/2020, and their total revenue is 524. And then cost of revenue is 395. And yeah, that's it. And then the net income is about 15. So now you can see why I chose, Walmart to compare with Apple, because, the total revenue is almost twice as much as Apple. Cost of revenue is actually higher as a percentage. 75% of revenue for Walmart is cost of revenue. The same number is 62%. And then the gross profit is actually less for Walmart since the cost of revenue is too high. And then the net income, for $524 billion of sales, net income 15 billion is about 3%, and that's significantly lower compared to Apple. And this is pretty common, between tech companies and then retail companies. So, for instance, let's do another one. If we were to talk about, say, Netflix, another tech company. So let's copy this like this. So let's go right here. Right. So the total revenue so I chose Netflix, go to financials, and then we go to income statement and make sure that it's actually annual. So the total revenue for December 31st, 2019, total revenue is about 20 billion. Cost of revenue is 12.4. So it's a small compared to these two giants. So I'll go with the decimals. And then the gross profit will be about 7.6. And then the net income is about 1.9. So Netflix is somewhere in the middle. It is a tech company, so we kind of expect them to have a high margin. Notice it's approximately as high as Apple. So maybe I should make it just a bit smaller. So notice how Apple had it 38% approximately, and Netflix has a 38%. So they're very similar. But compared to Walmart, their gross profit is higher. Or compared to Walmart, their cost of revenue is lower. And then when you look at the net income for Apple is 21% of the revenue. So every dollar that Apple collects, sells a service or a product, 21% of it is net income for shareholders. For Walmart, every dollar that they sell or provide as a service, they actually get to have 2.86% of it as net income for shareholders. And for Netflix, every dollar that they collect for the services that they provide or the goods that they sell, they get to have about 9.5% of net income for the shareholders. So why is the common size income statement helpful to us? Because you can see we can compare 3 different companies, 3 different size, different industries, different business types, and you can actually conclude significant financial results based on these percentage comparisons. And the common size income statement, literally taking each of these items and divided it by the total revenue so that you would have a better understanding of how that company's income statement compares to an income statement of another company. So that's about it about the common size income statement. So please let me know if you have any questions. Thank you.